How's it going, everyone? My name is Sam. I want to go over some common terminology used in the stock market and in investing today because I realize that there are a lot of people that have just started investing this year. So I want to make this like maybe a weekly series or something. And I haven't decided exactly how I want to do it, but I'm going to start with some of the more common, easier to understand terms, a little bit easier, and then we'll get more difficult as time goes on, get to terms that are used a little bit less often. But hopefully this can help a lot of people that are new to the stock market. And I realize a lot of the people that follow me are investors already, so this might not apply for you exactly. But if you want to share it with someone that you want to teach about the stock market, it might be a good thing. So we're just going to break down some common terms. If you guys don't mind hitting the like button though and hitting subscribe, definitely appreciate that. There is a link down there to WeBull too if you want to start investing. You can get up to $1,900 if you deposit $100. It's a lottery system. So the first thing that we need to talk about is just what a stock is. So a stock is a part of a company that you buy ownership of. So let's say I own a company. I want to raise some money. So I want to have more money to expand and have money to spend on my business. I might give away shares of my company. So I might keep maybe 50%, but let's say my company is worth $100. I can break up the other shares, let's say into 50 pieces. So I have half, then $50 is split up into 50 pieces. So I could sell those shares at $1 a piece and I could use that to fund the company or something like that. And then you get part ownership of my company. So if I make money, you make money. Now, the stock market in general is where shares of publicly listed companies are traded. So my shares of my company might be on the stock market. Now, a lot of the time people say the stock market's going up or the stock market's going down. Usually they're looking at something called index funds where let's say they say the stock market's going up. They're talking about index funds, which are just groups of these companies that are publicly traded. And they can be small companies, they can be large companies. It's like they try to put different kinds of companies in some of these index funds, like the S&P 500 index fund is probably the most used example of when the stock market's going up. People are usually looking at the S&P 500, but they look at some other ones too. They're 500 of the largest companies. So that is what the S&P 500 is. Now, sometimes you get invested and you buy shares of the company and they give you something called dividends. So dividends are cash payouts to shareholders, so people that own shares of the stock, and they gave you literally cash from owning shares. So they make money. Let's say I make $10 or something in profit after I pay everything out. Then I might give you some money back in the form of dividends. Now maybe I don't give you dividends and I just reinvest the money back into the company. That's something that some companies do too. So you can get shares that give you dividends. Those are called dividend stocks. And then you can also have something called growth stocks. So let's say I'm growing my company and I want to grow it really quickly. So I don't give out dividends because it would be better spent in the company to increase my revenue or increase my profit. So later down the line, we can get paid more money. So that would be considered a growth stock when you are growing very quickly, and usually you're reinvesting a lot more into the company than you are giving money out to shareholders, because that's what it takes to grow. You need to spend money back in the company a lot of the time. Now, something that was really confusing for me early on, and I just couldn't get it right. I couldn't wrap my head around it at first when I started investing, was bull market versus bear market. And it sounds odd when you hear about this for the first time. A bull market means that stocks are pretty much going up, right? People are excited about the stock market. People are investing. The cost of the stocks are going up, which means that if you invested, your money is going up. Now, a bear market is where it's either stagnant for a long time or it actually goes down in price. So usually that is not a good thing for investors, but it's usually a good thing for people looking to start investing because they're getting the same companies at a lower price. So then once they move back up, they make more money if you invested when the stocks are low. One thing that people often say too is that stocks are trading sideways. So that means that they're not going up, they're not going down, they're going pretty much sideways. And sometimes people might say that if stocks do that long enough, it might be a bear market because they're just continuously staying at that level. Now, along with bull market and bear market, people say bullish and bearish. So it's kind of the same thing. The way I remember it is if you're bullish, your horns are down, you're going full steam ahead, it's good. If you're bearish, I think about a bear, going up on its hind legs and stopping. So it's a bad thing. I don't know if that helps or not, but bull is good. It's going forward. Bear is staying in its tracks, or it's negative overall. So that's just kind of how I remembered it early on. It's kind of like trying to remember left and right when you're young. Sometimes that's hard to remember too, because it's just something you have to memorize. Then if you're really bearish on a company, if you think that it's going to go down, right? If you don't believe it's going to do well, you can do something called shorting the stock. So we won't get too into depth on that, but essentially these people that are shorting the stock are called short sellers. And they're betting the company is going to go down. What they do is they borrow the shares from someone else, and then they sell them, and then hopefully the share price goes down, essentially, and then they can buy them back and give them back for a lower price. So then they make the difference, if that makes sense. There are different kinds of investors. There are retail investors or individual investors like you and me, where we're just investing our own money. And then there's something called institutional investors. Institutional investors often invest for something called hedge funds or mutual funds or other big pension funds. They're usually investing other people's money. So people might give them money to invest for them. Compared to us, where we are retail investors, we're investing our own money. Institutional investors have a lot of weight in the stock market because they're working with large amounts of money. They might buy hundreds of millions of dollars of some stock in a day. They might buy $1 billion. They might buy more or less than that. But we typically aren't going to move the stock market as much as one institutional investor. Now, of course, you've probably heard about GameStop and how it went up drastically because a bunch of retail investors came together and tried to push up the share price. But that's more difficult to do over the long term. It's really hard to keep at that level because people made a lot of money. They want to take the money out. So that's kind of how it's broken down. You have institutional investors, hedge fund managers, people moving big amounts of money, and then you have the individuals, the retail investors. So individual and retail versus institutional. Now these investments go in something called a portfolio. So if someone asks you what your portfolio is, they're asking what investments you have. So it's like an overarching basket. It just is how your investments are broken down. So if I hold Google stock, Facebook stock, and Apple stock, that would be my portfolio right there. And you could break down like how much of the overall portfolio, so how much is all of it worth, and how much do you have in each single company? Like, do you have a third? Do you have a fifth of your assets or your portfolio in that company? And you can break it down like that. And if you have a good number of companies in there, you're what's known as diversified, right? You have a good number of different companies. That means that you're diversified and there's less risk. So people talk about the pros and cons to diversification. One way to think about it is if you had all your money in something that went up really quickly or just like a decent amount, you might beat someone that's well diversified, but you have a lot higher risk, right? Because if you're investing in a company and it goes down, that's the only company you have. Let's say it goes bankrupt. That could be horrible. You could lose all your money then. So that's where diversification is a balancing act. You don't want to have every company out there, most likely, because you're going to get a lot of bad companies. But you don't want to have too few companies either. A lot of people either go index funds and buy index funds. So they might buy the 500, the S&P 500, and just always buy that. Or if they're individual investors, they usually hold between 15 and 30 different companies. I'm a little bit more diversified, but that's because I have some penny stocks, so companies that are worth less than $5. Usually they're risky, they're higher reward, but higher risk a lot of the time. So I hold some of those, but I hold very small amounts of them. So I have a handful of companies like that, so I have more holdings overall because of that. Let me know what kind of terms you guys want me to give in the next video, or if you are interested in any specific terminology like retirement funds. We can go through 401ks, IRAs, that kind of thing. But let me know your thoughts down below. Let me know if you like this. And if you want to share it to someone that you know that you want to have some knowledge of this kind of stuff, definitely share it to them. Thank you guys so much. I appreciate you hitting the like button and checking out the link down below to WeBull or to M1 Finance, another investing app where you can get $30 if you deposit $100. And I will see you guys in the next video. Bye.